Let's turn our attention now to begin with the economy and what we heard from the Fed last week. Joining us now for that conversation is Eric Winograd. He is a senior economist, fixed income, over at AllianceBernsteinSeniorEconomist. Eric, great to talk with you this morning. So let's begin with the news that we got, or we expect to get later today, of a stimulus bill actually passing and getting some of that aid that we've expected and many have called for the last few months. Was this kind of your base case thinking about 2021? Is this maybe going to boost that outlook? And how do you expect this additional money into consumers' hands to change things as we get into the first half of next year?
Yeah, Miles, thanks for having me. Certainly from an economic perspective, I think it's good news that we did get some stimulus. I would argue that had already been well priced into the market. And if anything, I think probably a slightly larger package had been priced in. Recall that before the election, most in the market were talking, and certainly people in Washington were talking about a bill that might have been $2 trillion or perhaps even more than that. So, again, 900 billion. It's hard to keep track of just how large these numbers are. $900 billion is a lot of money. Better late than never, I suppose. And so it is certainly good news. I think it is important for those people who have lost their job to receive continued support. And it does brighten the outlook a little bit for next year.
And so,
Eric,
Eric,
Miles and I.
Sorry, go ahead, Sas.
No, I was saying, Eric, Miles and I were just talking about the outlook for inflation, and that talk is starting to pick up on Wall Street. How serious is that inflationary talk right now on Wall Street?
So I heard you and Miles talking about that, and I'm on his side, not yours, Saz. I think that the idea of inflation picking up next year in a way that requires a Fed response is a very distant prospect, and I think that the market generally understands that. It's not that inflation might not pick up. I think that as the economy improves, it probably will. But the change that people need to recognize is that the Fed isn't going to respond to that. And if anything, they're going to encourage it. The Fed wants inflation higher. And so I think it would be a mistake for the market to see prices rise and then conclude from that the Fed is going to act.
So, Eric, you probably heard then some of the risks that Brian was talking about to the equity markets potentially going into next year. What do you think are the biggest risks for fixed income? I mean, we talked about the possibility as well that there could be another aid package, especially if the outcome of the Georgia election is to add a couple of Democrats to the Senate. How are you thinking about that likelihood and what happens on the policy front next year?
So certainly the biggest risk to fixed income, the thing that is most likely to make rates move higher, is the idea that inflation expectations will go up and the Fed won't respond. That's how you get a much, much steeper yield curve, right? Historically, Saz is exactly right, that when prices go up, the Fed does respond, and that limits the extent to which you see an increase in yields. But over time, if you have a situation where inflation rises and the Fed doesn't respond, then from a fixed income market perspective, that does argue that the yield curve should steepen, which is in fact exactly what we're expecting. I don't think the Fed is likely to raise rates at least until 2023 and probably into 2024, even if the economy recovers. And I do expect a strong growth year next year. So if you get strong growth, some rise in inflation, and a Fed that doesn't respond, then the risk of a steeper yield curve mounts. Offsetting that, of course, is that the Fed is still doing quantitative easing in large size, and that will act as a restraint. But I think what we heard from Chair Powell last week is that they might be willing to stop QE long before they raise rates. And once that happens, the scope for long-dated rates to rise would be meaningfully higher.
Eric, years where the Fed is talked about a lot, 2018, to a lesser extent 2013, but 18, 2020, those are years that investors don't really want to remember all that much. They were tough years overall. Do you see the environment going back to this kind of close reading, Fed watching, where everyone's parsing individual words, but the average investor isn't seeing blaring headlines about Fed this, Fed that, the way that it played out in March and April? And do you see kind of focusing on the Fed becoming a more boring sport, as it were, as we get into next year? And all else equal, that's probably positive for markets.
It should, right? If the Fed does their job correctly, if they communicate what their actual intent is clearly, they should be more or less out of the game for next year, right? We have more clarity about the economic outlook than I think we've had since the COVID crisis started. Things look a little bit better than they have. The Fed really shouldn't be in the picture. My fear is that because the Fed's communications have been so vague, because they have been unwilling to be specific about what they mean in terms of the average rate of inflation over what time horizon, how much over 2% are they willing to tolerate? For how long? That runs the risk that the market will do exactly what you say, Miles, and start to wordsmith it again. And every time Chair Powell speaks, the market could say, oh, no, does that mean that they're closer, further away? I firmly believe that they are a very long way away from tightening policy. But I think that it would be helpful for markets and for the economy for them to be a little bit clearer in the way they communicate that. I do think the market is going to test them at some point next year because they've left themselves a lot of wiggle room. And the market is going to say, OK, what does substantial mean? What does significant mean? What do all these little words mean? And if the Fed answers those questions correctly, then they should be able to put it on cruise control for the rest of the year. If they don't, then it increases the risk of volatility that wouldn't be helpful and, at least in my mind, isn't necessary.
Yeah, the old 6 months slip, I think, was the first thing that
right.
Janet Yellen screwed up back in 2014.
Right.
All right. Eric Winograd is a senior economist for fixed income over at AllianceBernstein. Eric, great to speak with you this morning. Have a great holiday and Happy New Year.
Thank you. Thanks for having me.